Welcome to The Long and the Short, a show where you can expect an honest take on trading, something you won't hear elsewhere. I'm your host Sandeep Rao. Today we are starting a new series on what we believe is the single most important aspect of trading. They say you can survive with a half-baked trading strategy, but you cannot survive with a half-baked position sizing system. And yet, position sizing is often one of the most overlooked parts of system design. We spend an inordinate amount of time obsessing over entries, indicators, and setups, and then stop. In reality, that should be the beginning. Strategies, performance, and backtest are not the end goal. In fact, they should form the foundation for the next critical step: position sizing. In this episode, we'll start with the basics, the core ideas and the key concepts you need to understand before you can apply position sizing to a backtest or tailor it to a specific strategy. So without further ado, let's get started. Like I always do, let me start with the most fundamental question. What is position sizing? At its core, position sizing answers a simple and critical question. What is the optimal maximum amount of capital you should allocate to a strategy? That allocation in turn determines the size with which you actually trade. Say you had 20 lakh in cash. Should you deploy all of it into a single strategy? Or should you deploy, say, 5 lakh, that is 25% of your capital? Those decisions are not strategy questions. They are position sizing questions. Position sizing sits at the intersection of money management and risk management. Money management is about optimal capital allocation. Position sizing helps answer how much minimum capital does a strategy require? How much of my total capital should be allocated to it? Risk management, on the other hand, is about survival. It asks, what happens if the worst case scenario plays out? How much can I lose before I risk ruin? A well-designed position sizing framework ensures that even during maximum drawdowns, you are still in the game. And there is a third, often ignored dimension. Good position sizing should also allow for a good night's sleep. If your position size keeps you checking screens at 2 am, it's probably wrong, no matter how good the strategy looks on paper. This idea isn't new. Over 250 years ago, Daniel Bernoulli, best known today for Bernoulli's principle in fluid dynamics, also made a foundational contribution to economics and statistics. He was one of the first to articulate the idea of risk and utility. His insight was profound. Risk and reward are always relative to what you already have. A 10,000 rupee gain means very little to someone with 1 crore in capital. The same 10,000 gain is transformational for someone with 1 lakh. Same outcome, completely different impact. That single idea is the philosophical root of modern position sizing. And the reason why how much you trade often matters more than what you trade. It shouldn't be too small to be meaningless, and neither should it be too big to stress you out. As we try to understand position sizing more deeply, we'll look at several fundamental concepts. Let's start with the first one. Charlie Munger has a wonderful quote: "All I want to know is where I'm going to die, so I'll never go there." That's exactly what I want to talk about here. In trading, this idea is called risk of ruin. It refers to the risk of losing capital to such an extent that you no longer have enough money to play the game again, even if your strategy still has an edge. Let me explain with a NIFTY example. Suppose you need 1.9 lakh as margin to trade one lot of NIFTY futures. Your broker account has 2 lakh, which is your entire capital. So that leaves you with a buffer of just about 10,000 rupees. At the current lot size of 65, a 200-point move in NIFTY translates roughly to 13,000 rupees gains or losses. With NIFTY around 25,500, a move of just 0.8% against you wipes out that entire buffer and some more. At that point, it doesn't matter how good your strategy is and what the backtest says, you're simply out of the game. That is risk of ruin. It's about taking a loss so large that you lose the ability to participate altogether. And this is why position sizing exists. Not to maximize profits, but to make sure you never reach the point of no return. So now that you know what risk of ruin is, you can apply it to any aspect of your life. I'm personally quite obsessed with it, but that's for another day. Over to the next one. Next, let's talk about contract value, also called notional value, and how it relates to lot size. When you buy shares in the cash market, things are simple. If you buy one share of Reliance at 1400 rupees, you need exactly 1400 rupees and you own one share. Derivatives, that is futures and options, work very differently. In the F&O segment, trades happen in predefined units called lot sizes. The lot size defines the minimum tradable quantity of a derivative contract. Take Reliance as an example. If you check the F&O margin calculator and select Reliance futures, you will see the lot size is 500. This means you cannot trade 1, 10 or 100 units. You must trade a minimum of 500 units in a single futures contract and in steps of 500. In the cash market, if you want, you can buy just one share of Reliance. But in the F&O market, you must trade one full lot and there is no smaller unit. So far, this explains what lot size actually means. Now let's move to contract value, also known as notional value. Since one futures contract contains 500 units, the contract value is calculated as lot size multiplied by underlying price. In case of Reliance, it would be 500 multiplied by 1400, that comes to 7 lakh. So when you trade one lot of Reliance futures, you are effectively trading a contract worth 7 lakh, even though you don't pay that amount upfront. This notional value is what ultimately drives risk, exposure, and position sizing. Now that we have covered contract value and lot size, let's move to the next crucial concept, that's margin. In the cash market, things are straightforward. If you want to buy one share of Reliance trading at 1400, all you need is 1400 in your account. But in derivatives, that is futures and options, things work very differently. First, as we've seen already, trades in F&O happen in lots and each lot represents a contract value. But unlike in cash market, you don't need to pay the full contract value to take a futures or options position. Instead, you only need to provide margin. Now what is margin? Well, margin is the amount you must deposit to buy or sell one lot of a derivative contract. Think of it as a security deposit, not the value of the trade. Continuing with our example, one lot of Reliance futures has a contract value of approximately 7 lakhs. Margin required as of today is 1.25 lakhs. Now you may ask, how is this margin calculated? Margin has two components. One is called the SPAN margin. SPAN stands for Standard Portfolio Analysis of Risk. It's a proprietary licensed risk model developed by CME Group, originally the Chicago Mercantile Exchange. In our example, SPAN margin is roughly around 1 lakh. That's 14% of the contract value. This portion covers the statistically estimated worst case loss over a short time horizon. Two, we have something called exposure margin, which is added on top of SPAN margin. Now this exposure margin is mandated by SEBI. In our example, exposure margin is 25,000. That's about 3.5% of the contract value. Exposure margin is close to 2% for index derivatives and 3 to 4% for stock derivatives. This margin exists as an extra safety buffer to account for gaps, tail events, or situations where risk models may fall short. Putting it all together, SPAN margin would come to 14%, exposure margin around 3.5%. The total margin comes to approximately 17% of the contract value. So to take a 7 lakh futures position, you only need to commit about 1.25 lakh upfront. This 1.25 lakh is what is called margin. It's the amount you need to lock in or deposit to assure the broker and the exchange that you can absorb adverse moves while the position is open. So far, we've covered risk of ruin, lot size, contract value, and margin. The next concept in line is leverage. This is one of those ideas, if used correctly, can be extremely powerful, but if misused or misunderstood, it can lead to very quick ruin. So it's worth slowing down and understanding this properly. As we learned in the Reliance cash market example, the value of an asset and the amount of money you put in are exactly the same. It's simple and intuitive in cash market. Futures work very differently. In our early example, one lot of Reliance futures has a contract value of roughly 7 lakhs. But the margin required to take that position is only about 1.25 lakh. Now you're controlling a 7 lakh position by committing just 1.25 lakh upfront. That difference between contract value and the margin is what creates leverage. Conceptually, it's similar to making a down payment on a bike or a house. You control an asset that is several times larger than the cash you initially put down. Leverage is very easy to calculate. You simply divide the contract value by the margin required. In this case, 7 lakh divided by 1.25 lakh works out roughly to 5.6 times leverage. In other words, by putting up 1.25 lakh, you are controlling an asset that is 5.6 times larger in value. This is where they say leverage starts to cut both ways. A 2% move in Reliance is roughly 28 rupees. For one lot of futures, that translates to a profit or loss about 14,000 rupees, since the lot size is 500 units. When you look at the 14,000 rupee move relative to the margin of 1.25 lakh, it amounts to 11.2% swing in your capital. A small move in the underlying stock suddenly becomes a very large move in your account. Now imagine what happens if you have only 1.25 lakh in your account and you use all of it to buy one lot of Reliance futures. If the stock moves down by just 28 rupees, a significant portion of your margin is wiped out. You will receive a margin call, and if you don't add more funds immediately, the broker will square off your position. That is why they say leverage sits at the heart of position sizing and risk of ruin. It magnifies profits, losses, and mistakes all alike. Used carefully, it can enhance returns. Used carelessly, it can end your trading career far sooner than you expect. What we've just seen is how leverage works in futures. One important thing to remember is that in futures, the margin requirement is the same whether you go long or short. Buying futures or selling futures involves identical margins because the risk profile is symmetric on both sides. Options, however, work quite differently, and it's important to understand this distinction clearly. In options, there are two primary ways to express a market view: buying option and selling or writing options. If you have a bullish view, you can either buy a call or sell a put. If you have a bearish view, you can buy a put or sell a call. While the directional view may be similar, the mechanics, leverage, and risk involved in buying options versus selling options are completely different. Let's start with buying options. Operationally, buying an option is somewhat similar to buying a share. You pay the full price upfront. The crucial difference is that an option is a highly leveraged instrument. To give you an example, look at the current month Reliance 1400 call. It's priced at 33 rupees and the lot size is 500. The total cost of that trade would come to 16,500. That's a very small amount, and it gives you an exposure to an asset worth roughly 7 lakh. Now, even if I conservatively assume that the option has a delta of just 0.5, you're still effectively controlling an exposure of close to 3.5 lakh. Now, how did I get to 3.5 lakhs? That's 7 lakh multiplied by 0.5. It still works out to be greater than 20x leverage. Now, despite this high leverage, the risk in buying options is limited. The maximum you can lose is the premium paid, that is 16,500 rupees in this case, while the upside can be very large and unlimited if the trade moves in your favor. Now, because you pay the entire premium upfront when you buy an option, no margin is required. There is no further financial risk to the broker or the exchange beyond the premium you have already paid. This logic changes completely when you sell or write options. When you write a call or a put, your maximum gain is limited to the premium you receive, but your potential loss can be very large, and in some cases, theoretically unlimited. Because of this asymmetric risk, selling options requires margin very similar to that of futures. If you look at the margin required to short a single Reliance call, you'll notice it is substantial and similar to what you need for one lot of futures. That margin exists to protect the system from large adverse moves, since option sellers can lose far more than the premium they collect. In short, futures apply leverage symmetrically whether you are long or short, but options separate leverage very clearly. Buying options gives you high leverage with limited risk and no margin requirement, while selling options involves limited reward, potentially large losses, and therefore significant margin. Understanding this distinction is essential when thinking about position sizing. So far, we've understood how margin requirements work and how they create leverage. Now I want to focus on a money management concept that becomes very important when we talk about position sizing. When we discuss margin for futures or options, we saw earlier that you need roughly 1.2 lakh to trade one lot of Reliance futures or to short one lot of options. The natural question that follows is, does this entire 1.25 lakh need to be in cash? That's what I want to address next. To understand the cash requirement rules, we need to understand the concept of pledging. something I covered in detail in episode 7. If you're new to this idea, I strongly recommend watching that episode first. Now in the F&O segment, positions can broadly be of two types, intraday and overnight. The margin required for a product does not change based on how long you hold the position. However, how that margin is funded does change. For intraday positions, you are allowed to use pledged collateral fully to meet the margin requirements. But for overnight positions, there is an additional rule. At least 50% of the margin must come in cash or cash equivalents, and only the remaining 50% can be funded using pledged collateral. This so-called 50% cash rule effectively defines how much liquid cash you must maintain in your trading account. Let's go back to our 1.25 lakh margin example for one lot of Reliance futures. Assume you have 2 lakh invested in an index fund, and you pledge those units with your broker. If the collateral haircut is roughly 10%, you receive about 1.8 lakh as collateral margin. If you are trading intraday, you can technically use the entire 1.8 lakh of pledged collateral to take one lot of Reliance futures without needing any additional cash. However, if you plan to hold the position overnight, the rules change. You must have 50% of 1.25 lakh, that is 62,500 approximately, in cash or cash equivalents, and only the remaining 62,500 of the margin requirement can be met using the pledged collateral. Now, why am I bringing this up? The reason is simple. When you trade a positional strategy, the requirement to keep 50% of the margin in cash creates an opportunity cost. That cash has to remain blocked for trading, even though it could have been deployed elsewhere. For example, suppose you have 10 lakh in total capital, you decide to keep 5 lakh in cash for positional trading while investing the remaining 5 lakh in an index fund that could reasonably earn 10% over time. That expected return on the index fund effectively becomes your baseline. Any returns you generate from trading using the cash portion needs to at least beat this baseline just to justify the capital being tied up. This becomes even more important when you run both positional and intraday strategies simultaneously. Intraday trades may allow full use of pledged collateral, while positional trades lock up cash. Without a clear understanding of these rules, it's very easy to misjudge how much capital is actually free and how efficiently it's being used. That's why understanding cash requirements is an important optimization problem. Most professional traders I know spend a significant amount of time thinking about how to structure and deploy their cash, and for good reason. I think efficient cash management can make a huge difference to the overall portfolio returns. So we've covered everything from risk of ruin all the way to how pledging securities can help manage cash requirements more effectively. This, I think, is a good moment to revisit one of the backtests we discussed earlier. If you remember, in episode 11, we ran a trend following strategy on NIFTY and gold, where the NIFTY leg experienced a drawdown of about 18.5%. Now here's the question I want to leave you with. Suppose we decide to trade only the NIFTY leg using NIFTY futures and ignore the gold for the moment. Given everything we now understand, drawdowns, margins, leverage and cash requirements, what would be the minimum capital allocation for this strategy? Think it through and let me know your answer in the comments. That's it for this episode. In the next part, we'll take the NIFTY backtest and walk through a step-by-step position sizing plan. We'll also look at how to increase or reduce leverage in a controlled way without pushing the strategy into the risk of ruin territory. I hope you found the episode useful and interesting. Do share your questions, thoughts and feedback in the comments, and I'll do my best to respond. Thank you for watching and see you in the next one.